While you were sleeping, the crypto market fundamentally changed. AI-driven tokens are processing billions in transactions, institutions are moving trillions through DeFi protocols, and new regulations just created the clearest roadmap we've ever had. Miss this shift, and you're not just leaving money on the table, you're watching the next generation of wealth builders pass you by. I'm about to break down the 3 seismic changes happening right now that separate the winners from the bystanders in 2025. Here's what makes 2025 different from every other crypto cycle. BlackRock, Visa, and PayPal aren't just dipping their toes. They're processing trillions in stablecoin transactions. This isn't speculation anymore. This is institutional adoption at scale. And if you understand what's driving this transformation, you position yourself ahead of 99% of retail investors still chasing yesterday's narratives. Welcome to Generational Wealth, your pathway from knowledge to legacy. First shift. Artificial intelligence isn't just hype, it's becoming the backbone of crypto infrastructure. Let me give you 2 examples that matter to your portfolio. Render Token and Bitensor are powering decentralized machine learning networks. What does that mean in plain English? These tokens let you own a piece of the AI revolution without buying overpriced tech stocks. Render processes 3D graphics and AI computations across a distributed network. Think of it as Airbnb for computing power. But here's where it gets interesting for investors. AI-driven trading algorithms are now managing institutional-level portfolios with precision humans can't match. These aren't the bots from 2017 that got liquidated. These are sophisticated systems analyzing on-chain data, sentiment, and macroeconomic factors in real time. The play here? Diversification into AI crypto infrastructure tokens gives you exposure to both the AI boom and crypto adoption. It's a double leverage opportunity that traditional markets can't offer. Second shift. DeFi isn't the Wild West anymore. It's becoming Wall Street's playground, and that changes everything. Cross-chain bridges are finally working seamlessly. You can move assets between Ethereum, Solana, and other chains without the friction that killed opportunities in previous cycles. This matters because liquidity isn't trapped anymore. It flows to the best opportunities instantly. Decentralized derivatives markets are now attracting hedge funds and family offices. We're talking about sophisticated financial instruments that used to be exclusive to accredited investors, now available to anyone with a wallet. The total value locked in these protocols? Over $200 billion and climbing. But here's your warning. Security exploits still happen. The difference between thriving and getting wrecked? Only use protocols with multiple audits, insurance options, and proven track records. Don't chase 500% APY yields from protocols launched last week. That's not investing. That's gambling with your generational wealth. Third shift. And this is massive. The Clarity Act just categorized every digital asset into 3 buckets: investment contracts, digital commodities, and stablecoins. Why does this matter to you? For the first time, you know exactly which agency regulates what. SEC handles investment contracts. CFTC oversees digital commodities like Bitcoin. No more gray zones. No more wondering if your holdings will get classified as securities overnight. The Genius Act goes even further with stablecoins, requiring 100% liquid asset backing. Translation? The stablecoins that survive this regulation become the safest on-ramps and off-ramps for your crypto positions. USDC, USDT, and compliant alternatives are about to dominate. Here's the strategic advantage. Regulatory clarity brings institutional capital. When pension funds and endowments can legally allocate to crypto without compliance nightmares, trillions more flow into the market. That's your opportunity to position before the flood. So are you going to move on these 3 potential strategies? 1. Allocate 5 to 10% of your crypto portfolio to AI infrastructure tokens like Render or Bitensor. You're buying the picks and shovels of the AI gold rush. 2. Use established DeFi protocols for yield generation, but only those with insurance options and multi-year track records. Think Aave Compound. Boring wins in DeFi. 3. Position in regulatory compliant assets. XRP's Clarity, stablecoins with proper backing, and projects working with regulators instead of against them. This is the mature market play. Risk management? Never invest more than you can afford to lose. Diversify across these 3 categories, and take profits on the way up. Generational wealth isn't built on one moonshot. It's built on consistent, strategic positioning. The 2025 crypto landscape rewards the informed and punishes the reactive. Which side are you on? Drop a comment with your biggest question about AI, crypto, DeFi, or these new regulations. I'll answer the top ones in my next video. And if this breakdown gave you clarity, smash that like button and subscribe so you never miss the insights that keep you ahead. Let's build that generational wealth together. Quick disclaimer: I'm not a licensed financial advisor. This is for educational purposes only. Crypto is volatile. Never invest more than you can afford to lose. Do your own research. Thank you for watching. We appreciate your support. See you on the next one.